Welcome to Yahoo Finance Live. This is Wednesday, June 14th. We are moments away from the Fed's decision on interest rates. Wall Street widely expecting the central bank to pause raising rates after 15 straight months of hikes. We're going to be watching the market reaction closely here as we see the Dow down 153 points, the S&P 500 up 6, and the Nasdaq up 18. We're talking about a pause here, Julie, but the Fed would like to call it a skip.
Yes, or as the street has now deemed it, a hawkish pause. That is the jargon of the day. What does a hawkish pause mean? It basically means a skip. It's the same thing, right? So the expectation is that they are not going to raise interest rates today, but in both the statement and the press conference will set the table for potential more interest rate increases. Of course, I have a feeling we're going to see and hear the words data dependent continuing today, right? Because it will depend on whether inflation does start to abate more in the coming months.
Well, and of course, we're talking about a pause here in light of recent data that does point to inflation cooling still well above the Fed's 2% target. But the Fed certainly wanting to take a pause, a skip, however you want to characterize, essentially to see how much of their rate hikes have been taking hold, give it a little more time before they move even more aggressively, and the market expecting potentially a hike come July.
Right, because the whole thinking behind this is that it takes time for interest rate increases to make their way through the system. So now that the Fed has done 10 in a row, the idea is they sit back, start to look at the data, see if it is starting to come through. There's a lot of debate right now about where inflation is actually coming from and how much the Federal Reserve can actually affect those sources of inflation at this point, or whether the usefulness of rate increases has almost kind of met its end here. So I think there's a lot of discussion around that, and we might hear some questions to that effect in today's press conference.
And of course, we are awaiting that FOMC statement there. But beyond that, a lot of focus will be on, of course, the Jay Powell's press conference later this afternoon. I want to go to Jen Schomburger, who is standing by for us at the Fed with the decision. Jen.
No change. The Federal Reserve holding rates steady in the current range of 5 to 5.25%, but raising interest rate projections to a new peak of 5.6%, implying at least one more rate hike from here, or about 37 basis points more of upside. Now, if we look into next year, officials projecting 100 basis points in rate cuts to around 4.6%, though that is higher than what was previously projected, around 4.3, meaning that officials are going to hike rates higher and hold them higher for longer. Now, 9 officials see raising rates to that 5.6 level, while 3 officials saw raising rates as high as closer to 6%. In its statement, the Fed justified its pause today, saying, quote, holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. However, officials did maintain language from the previous statement to leave the door open for further rate hikes, saying that in determining the extent to which, quote, additional policy firming may be appropriate, the committee will take into account the cumulative effects of monetary policy, the lags with which monetary policy affects economic activity and inflation. Now, officials still view inflation as elevated. In fact, their projection for inflation for the end of this year is now closer to 4%, 3.9%, which is higher than previously forecast at 3.6%. Unemployment now seeing rising only to 4.1% from 4.5% previously. And economic growth was also upgraded to about 1% versus 0.4% before. This decision, unanimous. Back to you.
Jen, really interesting here as I look through the context of this, but I think that the summary of economic projections, also known as the dot plot, is indeed going to get a lot of attention. So just wanted to zero on that. You did mention here that the Fed is effectively saying, yes, it's pausing now, but because it's raising its forecast for where rates will be at the end of the year, that definitely does imply we could see more rate increases after this month.
Yes, exactly, Julie. The fact that we're seeing 5.6% implies that there's more than a quarter point rise here that officials are projecting. That's like a little bit like 0.125 over that 25 basis points. So again, about 37 basis points of upside here. But, you know, they're leaving the door open here, and inflation remains highly elevated, well above the Fed's 2% inflation target, clocked in on the CPI latest at 5.3%. So we'll hear from Fed Chair Powell here in less than 30 minutes about whether, you know, that is their projection for now. And depending how sticky inflation is going to be, the fact that they now see it ending the year at close to 4%, I really think speaks volumes here.
Yeah, so interesting here because you know, as you said, there are some market participants here who are still looking for a cut in rates. Thanks so much to our Jennifer Schonberger down there in D.C. covering this breaking news. I'm taking a look at stocks here, and what I'm seeing, at least initially, is a little bit of a leg downward for the major averages here. The Dow in particular off by about 0.8% here. There you see on the intraday chart what we're looking at, that sort of leg downward in stocks. So initially a sort of negative reaction. Of course, it does tend to take a little bit of time for this to make its way through the market. We'll have to see what happens on the bond side of things as well. But interesting as we see this going on. For more Fed reaction, we are joined by Jordan Jackson, JP Morgan Asset Management Global Market Strategist. He's with us here in studio. We've got RJ Gallo, Federated Hermes, Senior Portfolio Manager, and Sarah House, Wells Fargo Senior Economist. I have to remind myself, it's like the Greek god, not like the French fashion brand Hermes. Let's start with you, Jordan, here with us in the studio. So it does seem like indeed we got the so-called hawkish skip or hawkish pause we were looking for. But with that summary of economic projections, maybe even more hawkish than we would have anticipated.
I think this is very hawkish. I mean, the idea that the dot plots have moved up to include about 2 more rate hikes coming from the Fed. I think now you're going to start to see markets maybe projecting, if the Fed wants to get closer to be done soon, maybe 50 basis points at the July meeting to get us there. That may start to begin to feed through to market expectations. It's been interesting. The statement looks almost identical to May. I mean, they continue to cite that inflation remains to be a concern. Job gains have been robust in recent months. And when I look at the other points of the SEP, they're calling for that soft landing and a slower trend towards inflation getting back to 2%, needing this more hawkish tone. But I think this is very hawkish. I don't think they need to keep raising rates. I think they should be done. Where there's still stresses in the banking system. I think we'll start to see labor markets begin to roll over in the next couple of months. But they've completely pushed back on the notion of any rate cuts happening on the back half of this year, given that they're solidifying further rate increases are likely to come. And
so much of this is going to be about the messaging coming through in that press conference. You talk about you don't think there's a need for additional hikes, and the stress in the banking system certainly going to be coming up in the press conference as well. I mean, can you talk about that very delicate balancing act the Fed now has to toe in the messaging here, essentially making it clear to the markets we're not done yet, even though we skipped, and yet we are aware of these other stresses that could materialize even further?
Well, I think they continue to see the hard data, which continues to be relatively firm, even though the survey data continues to roll over, be very weak. When you look at ISM services PMI, when you look at services of business confidence going forward, again, the survey data suggests that the economy is likely to come under a bit of pressure. They just aren't seeing it in the hard data yet, so that suggests that they think they've got to do a little bit more. But I have a real issue with the Fed continue to be backward looking. Right? Specifically when I think about the labor market, that's always the last shoe to fall. Once the labor market breaks, that's when you're in the recession, right? That's the definition of the recession. But we're seeing signs that I think the labor market will start to come under pressure. I think claims data tomorrow morning will be particularly important. You're seeing a fall off in the quits rate, a rise in the layoffs rate. Those are typically precursors to a bit of weakness. And so, again, I think the Fed should be done. I think further hikes, especially 2 more hikes potentially, is overdoing it.
Sarah, I'm curious to get your take here, not just on what the Fed is doing today, but what all of this implies about the likelihood of a so-called soft landing and the likelihood maybe, could we actually avoid a recession? Is that what is implied here, and is that correct?
Well, I think that's certainly in the SEP in terms of their projections, where they still have some pretty favorable growth rates. Although I think in some ways it doesn't quite jive with the unemployment rate projections that they're looking at. We're still talking about more than a 1 percentage point rise in the unemployment rate, which is going to take, I think, a good deal of job losses, considering just the inflows of labor supply, just given the demographic backdrop. So I think, overall, the SEP is still signaling that soft landing is possible. We just need a few years of below trend growth, and that you'll see inflation slowly come down, a little bit more slack in the labor market. But I think in some ways the GDP forecasts and the unemployment rate forecasts don't quite fit.
RJ, you agree?
I think Sarah makes some good points. I mean, the Fed is sending a little bit of a hawkish pause here. And in that sense, I think it confirms the market's expectation They're revising up growth, revising down unemployment. That said, unemployment will still rise materially from here, according to their dot plot. To be frank, I think that the Fed is trying to pull off something that's a little difficult right now. You had the FOMC statement, as Jordan mentioned, it hardly changed. The dot plot is a powerful communications tool, but it moves. It's a projection, it's not promises. I think the key here is what does Chairman Powell say from the podium? Is he going to be able to sort of embrace the hawkish message that we already see? Or is he going to modify it and soften the tone? There has been a tendency for the statement and the dots to send one message, and then Powell at the podium sometimes takes a slightly different angle. So what we really have to see what he says here, because he's trying to explain why they're pausing, even though they open the door to potentially more hikes if needed.
RJ, I'm looking at the CME Fed Watch, as I like to do. It moves a lot, to be clear, but it prices in where the market thinks the Fed is going to be. And there's a lot of diversity of opinion being reflected there, right? So right now, the odds are running at about 43.5% that there will be no more movement up or down in rates. But there's about a 20% chance being priced in of a cut, about a 30%, a little more chance being priced in of another quarter point hike. So it seems like, as you say, the market's kind of taken the dot plot with a grain of salt here.
Yeah, well, the dots have proven to be a means of communication. They have not been a very accurate projection. Go back to the beginning of this extraordinary hiking cycle. The Fed did not predict that we would be where we are today, 5.25 to 5.5%. That's why the market is looking at the dots and taking them with a grain of salt. They need to be viewed that way. I still think they have a powerful role, however. In any forum of life, if there's a committee making a decision and they will provide projections about what they think they will do, wouldn't you want to know what they thought? That's what the dots are. They're not promises, they're projections. Right now, the Fed is telling us they think they might have to tighten a little bit more. And then they're telling us we'll probably ease next year. That helps to allow the Treasury yield curve to remain inverted, as it incorporates this concept of easing in 2024, which it was obviously in the market before anyway. And as a result, the dots give the Fed some forward-looking projection tool that otherwise wouldn't come across as coherently. And I think that's partly why this rate hike cycle has been pretty extraordinary, and how you can have such a deep inversion. Because in most periods of Fed history, you didn't have the dots. You've only had dots for a couple of tightenings. And if you go back to the dots in prior tightenings, dots came along in 2012, what you'll see is the Fed did not forecast eases in the prior projections that they made back, 5-6 years ago. They have consistently been doing so here. And so the market looks at the dots with a grain of salt, but does take into account the directional communication that's coming out of them. The idea that we hike now, we hold, and we'll probably ease. Of course, they move around a lot despite that overall view.
All right, RJ, Sarah, and Jordan, hang tight. We want to keep this conversation going as we count down to that press conference from Fed Chair Jay Powell starting at 2:30 p.m. Eastern. But I want to get to the market reaction now with our very own Jared Blickery. Jared, I'm seeing the Dow losses accelerate, but also bond yields moving higher.
Yes, let's take a look at equities first. We can see the Dow is an underperformer here. It's down 1%. Russell 2000 down 1.3%. You can see took that leg lower here. The NASDAQ had been positive and it sunk into the red here. You can see a little bit off of its lows. But of course, we're still waiting for Powell to take the podium. And that's really when we see the fireworks. You mentioned bond yields. Well, here are the bond futures. 2-year Treasury note futures, they are sinking right now. That means yields are going up. And let me just take a look at some of the other futures movements here. First, actually, let me take a look at the dollar. This is going to be the euro versus the US dollar. So we're seeing a little bit of weakening in the euro, which is strengthening in the dollar, but not a huge move there. If this is, in fact, a hawkish pause, we would expect to see potentially a stronger dollar along with yields going up, and that's what's been happening here. Let me take a look at gold. You can see gold kind of buying into this, a little bit of hawkishness here, not a huge move, but we can see back down to the lows and exceeding the lows on the day. And then Dr. Copper, let's take a look at that. We can see copper futures down slightly as potentially the Fed kills off demand. That's how the thinking works, but not a big movement there. And then got to take a look at Bitcoin. A lot of people laughed. I was looking at Bitcoin over the last several meetings here because it has been highly levered and correlated with the Fed's balance sheet. And we can see a bit of weakening in Bitcoin as well. And I'd just like to remind people as I pull up the sector action, I went back and I looked at pauses historically. Global financial crisis, big one there. Fed was raising for a couple years. 2006, they paused into 2007 for over a year. In that time, guess what? The stock market rose, but the stock market was already in a bull market. Here, the market was in a bear market before the Fed began tightening. So that is a huge difference. Most of the sectors were in the green earlier. Staples is the only, and that's a defensive sector that's in the green here, along with tech just a little bit. Energy taking it to the downside along with healthcare. And here's a look at the NASDAQ as well. Not a lot of standouts in terms of green.
Well, I actually wanted to get you to double click on the NASDAQ a little bit here, Jared, because we have seen the fate of so many of these large cap tech stocks sort of move inversely to rates this year. That's sort of been less true recently when the AI enthusiasm is sort of taken over. But it's interesting that we don't see sort of a uniform reaction there. Microsoft, Nvidia, Microsoft barely, but in the green, and then, well, I lied, now Microsoft's in the red, but.
Yes, it's you.
Let's take a look at Nvidia here. Yeah. We did see a little bit of a slump in Nvidia. As we see treasury yields rising, that is not good for these longer term growth stocks, but not much of a hit there in terms of Nvidia. If it is in fact flying or has been flying off of bubblish circumstances here, guess what? That can trump everything else. You can throw fundamentals out the window. Microsoft down a little bit there as well. And let's check out some of the kahunas, Apple and Tesla. There's Apple sinking into the red, but not by much. And then where did Tesla go? They're down. Tesla down about 2%. Is it going to be up 14 days in a row? Not right now.
Not at the moment, no. But both of those stocks, Tesla and Apple, coming off of big runs. Apple, of course, very recently at a record high. Let's get back to our panel now. Jordan Jackson, RJ Gallo, Sarah House are all still with us. So Jordan, as we see this sell-off in stocks, and we know following these Fed decisions and during the press conference, we can get some volatility. Is what just happened negative for equities?
Well, I think the market reaction is basically saying you can't keep hiking rates forever, right? Stock prices have got to, be reflective of the rate environment. If they're going to keep hiking rates, then it's kind of hard to put a valuation on the market, a forward P on the market of 18.5 times. Especially if you think the earnings outlook is maybe not as rosy as currently what analysts are currently forecasting. It's just hard to put a multiple if the Fed is going to keep going here. So I'm not surprised to see markets are selling off, not just from an equity perspective, but from a aggregate demand perspective. If the Fed keeps hiking rates, this is going to continue to weigh on the banking stresses that we're seeing across regional banks. I think some of the economic projections aren't in line with a higher Fed funds, but also higher inflation expectations. I'm not really sure what forward inflation outlook the committee members are looking at. We're anticipating a 3.5% handle on inflation by next month. Remember, in June of 2022, month-over-month energy inflation was running at 6.9%, month-over-month, 7%. The last 2 months, used vehicle prices have risen by 4.4% in the last 2 months. Those things, base effects in energy, normalization in used car prices. I've found interesting the new index that the Cleveland Fed and in joint with the BLS, the new tenant repeat rent index, which now looks to be more closely tracking what we're seeing in terms of rental inflation, suggests some pretty significant disinflation coming from owner's equivalent rent over the duration of 2023 and into 2024. So you've got all these indicators, right, that suggest that inflation is heading back down and suggesting the Fed doesn't need to do all this extra hiking. And so, something's going to break here. And so I'm a little bit more worried, and I think stocks are a little bit worried as well.
Yeah, RJ, let me get your thoughts on how we're seeing the market react here on the back of this Fed decision. I mean, how much of this move to the downside is justified given what Jordan just highlighted?
I think it's interesting. Jordan said we're going to see something break. We already sort of did see something break. SVB, Signature Bank, emergency lending facilities that were put in place to help to relieve a stressed banking system amid the greatest monetary tightening in 40 years. We've seen some things break. And I think the Fed, in this message is suggesting they need more time to see the implications of those banking sector stresses. Nevertheless, they took the opportunity to signal in the dots that they'll tighten more. I would argue that the dots are sort of serving their purpose as a communications tool here. They must perceive that enough of the FOMC members must perceive that there's a risk that inflation just doesn't cool down enough, despite all the signals that Jordan mentioned, and I would echo that there are plenty of signals out there that inflation's on its way down. It's still too high relative to a 2% target, however. And I think the Fed might be trying to send us a subtle message here. They're pausing right now. They might be a skip, but they'll tell you if they had to move, they would tighten again. The dots are not promises. These can change again, but I think it fits their purpose to suggest that they have a hawkish lean so that the bond market doesn't start some huge rally and that the stock market also doesn't start some huge rally, which otherwise would occur if you said, hey, we're pausing, let's see what's next.
Well, and on that front as well, Sarah, you know, the stock market rallying is also one of the things that might make the Fed more likely to continue to tighten because it's sort of one measure of financial conditions loosening instead of tightening, right?
Right. So I think what's been in some ways the big surprise here with the Fed deciding to pause, skip, whatever you want to call this meeting, is that we've seen financial conditions ease since the last meeting, and they're also down since the start of the year. And so I think in some ways this was a signal that, okay, we're not gonna come through with a surprise. We are going to assess how the data unfolds, but we're still looking for those financial conditions to tighten. And so in some ways the surprise came through that dot plot with the bigger increase in terms of that median projection for the end of this year. So signaling that it's likely that we could see even more rate hikes than what was generally expected coming into this. So perhaps just a bit of a signal that, okay, maybe not a surprise at this particular meeting in terms of the outcome, but certainly ready to tighten financial conditions should it prove warranted, which, based on a variety of financial conditions indexes in recent months, it certainly seems to be.
So that's the read from the Fed, Sarah. But I'm curious how you read the most recent data that came out. To Jordan's point, there are already signs here that we are seeing things move in a disinflationary, basically cooling down in terms of where the price pressures are. I mean, do you agree with his, at least thesis, that the Fed is a little behind the ball on this?
So I'd agree in terms of we are seeing economic activity slow. I think the pieces are certainly in place for further and in some ways more market disinflation here in the coming months. But I think that moving in the right direction isn't the same as assuredly being back towards where the Fed wants to be in terms of inflation. So overall, we've seen economic activity be incredibly resilient, not just through this year, but over the intermediate periods. We've actually had economic surprises over the past month or so have been by the widest margin in about a year and a half. And when you also combine it with the inflation outlook, yes, we are looking at slower price growth ahead, but core inflation is still running roughly 2 times the Fed's target. And this is a Fed that talks about they want to make sure it's on a sustainable downward path, and we just haven't seen that quite yet.
So I think it's interesting. We're now at, if I'm right, and we get another downward move in inflation next month, that'll be 12 consecutive months of inflation continue to come down from its peak last month. I also think when you look at the lending environment, the tightening in overall lending conditions, there's a pretty close correlation between, if you look at the NFIB survey and take the availability of credit and the expectations of credit conditions going forward, that leading to a rollover in the labor markets. Now, again, the hard data, the labor market data is a lagging indicator, right? And so that's going to be the last shoe to drop. And so I think it's really important for investors to look to see what are sort of the trends coming out of the labor market. And so, it's looking at average hours worked. I think, again, that NFIB survey that suggests that credit conditions can continue to cause tighter conditions. And I try to remind investors, 52%, a slight majority of the private workforce is employed at a business that has 500 or fewer employees. Many of these small businesses bank at regional banks. And so you can see an environment in which they're now having to tap those business lines of credit recognizing that short-term business loans have gone from 4% in July of 2020, now sitting at north of 8% today. It's almost doubling. The availability of credit have become more restrictive, and so they're going to have a real tough challenge, and I'm going to have a tough time rebuilding inventory. I'm going to have to lay off staff. And that's how you get this tighter credit conditionings broadening out to the labor market.
What does that suggest in terms of what could be waiting on the other side of these 2 additional hikes from the Fed?
And that's the real challenge, because these regional banks are still dealing with issues both on the liability side as well as on the asset side. And that's leading into further tightening in lending conditions. And so if now I'm able to get 5.5% potentially, or north of 5% on a money market instrument, why get a couple basis points in my savings account? Also, higher rates are going to continue to weigh on property values. We know regional banks have outsized exposure to commercial real estate. That's going to continue to be a challenge on the asset side. And so, this is, I think they should be done. I think they've done enough. I think there are clear trends that the labor market's going to start coming under pressure. We're already seeing the disinflation beginning to feed through. And I think adding more rate hikes. And again, I know, RJ, as you highlighted, this is just a projection, not a promise. But I think it's signaling to the market that rates are going to be higher for longer. We want to see more tightening in financial conditions, given the loosening that we've seen as of late. But I think it causes more damage to the economy.
Well, Sarah, I mean, isn't this just, in some ways, this is a method that the Fed has, right? If the market believes it's going to continue to raise rates, it doesn't necessarily have to continue to raise rates, right?
Right. So it's a little bit of a game back and forth between this communication and using that as a tool itself. But as we've seen, these can change pretty quickly in intermediate periods. And so in some ways, I think it's just the Fed's going to have to keep at it with some of this hawkish talk. And I think at some point you'll have to see that hawkish talk backed up with potentially another rate rise. And we think we will get one most likely here in July.
It's worth noting we are about 5 minutes out from that press conference starting. We'll, of course, have that live for you here with Fed Chair Jay Powell speaking after this no decision, essentially, or pause from the FOMC today. RJ, from an investment standpoint, what does that mean? I mean, we've been talking about what the market's reaction is today, but how do you think about sort of going into year end, especially if the expectation is for 2 additional hikes from the Fed?
Well, in the fixed income side of Federated Hermes, we have been leaning a little longer duration in our portfolios. That might be surprising to folks when you consider that the short end of the curve yields have continued to back up, and they've 2-year yields, for example, are up, I think, like 23 basis points in relatively short order here. But the long end of the curve hasn't risen all that much. We've been extending duration because we believe the more the Fed does now, the deeper the recession they will cause later. So the curve can stay inverted. I think the Fed's dots just blessed that again today. Extending duration may mean that you're going to get a little lower yield than what you get in a money market fund. And we have plenty of those at my company, so you can stay in that if you want. But I think ultimately, by extending some duration, you're positioning yourself for the next chapter of this book. The next chapter is when the economy slows due to the many headwinds that have emerged and will likely intensify. And the Fed finally says we've done enough on inflation. We are going to start to ease to try to avoid too deep of a downturn. Once that, even a sniff of that is sensed by the market, bond yields fall, you get price appreciation, and your intermediate bond portfolio will outperform your money market fund at that point in time. Calling the exact turn and cycles is very hard, but now that we are at a point where the Fed has tightened 525 basis points, where unemployment has already started to rise, when we are well past peak inflation, I think now is the time to leg into some longer duration positions within your individual portfolio. We've done that in our portfolios. We actively manage all our bond funds, and we've extended duration to be long of our indices in order to take advantage for that development that we anticipate, that ultimately we're going to get some price appreciation in bonds. We're getting closer to that day.
All right, we're less than 3 minutes out until the press conference, but RJ, I just want to say one thing here, which is that everybody's been talking about this recession for what seems like forever. And I know you said it's hard to time it, but when is it? I mean, this year, next year? Is it really coming? Is it really going to be that bad? It just seems like it just keeps getting pushed out.
It does keep getting pushed out. I would suggest the recession we're going to see is one that may actually resemble what happened back in, say, 2000, 2001. You might remember that was the dot-com bubble bursting. There were many financial market implications, negative ones, from that. And a lot of interest rate sensitive segments of the economy slowed down, but consumer spending, roughly 70% of GDP, never went negative. It's quite possible we'll see that same dynamic in this coming recession. That means the recession's apt to be somewhat mild. If consumers who right now are abundantly employed, the unemployment rate is at 3.7%. That's just off the lows of the last 53 or 54 years. If it does rise up north of 4, which I think is a reasonable expectation, the Fed certainly signals that in their summary of economic projections today, it's possible that consumers will still have enough disposable income, will still have enough employment in the economy that the C in the GDP accounting, consumption, doesn't actually contract. In that case, it's a more mild recession, and the Fed is not returning to a zero lower bound. They're easing maybe 50 or 100 basis points, not 500 basis points, undoing what we just did. So the timing of recession, I agree, it's key. In this business, if you get your timing wrong too often, then you're just wrong. But I think ultimately this recession is coming. It's apt to be a mild one, and will ultimately be friendly to investors who are adding some duration now and in the next couple of months.
Really quickly, Jordan, as we count down to Jay Powell's press conference here, what do you want to hear from the Fed chair?
I'm hoping he adopts sort of, and he's been great at this, a bit of a bedside manner and striking a bit of balance. I think he needs to, be careful and not to sound overly hawkish and overcommit to these additional rate hikes and recognize that, acknowledge that, yes, inflation's still high, but it's working its way down. He'd made that very clear in his last conference that, we are already in the disinflation process. I think he needs to reiterate that message, but maybe strike a little balance. And I think primarily the Fed has been so focused on pushing against rate cuts in the back half of the year that almost to some degree, the talking up of rate hikes at the front end continues to push back against the notion of rate cuts later on this year. And so I think he should maybe emphasize that message, but he's got to strike a little bit of balance. There are still risks that are very prevalent within the economy. Inflation is, again, as we talked about, is showing some signs of abating. So I think he's got to strike a bit of balance at the press conference.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. One, decision hasn't been made. 2, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so. And I think if you look at the SEP, that is our estimate, our individual, it's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting, it's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward. And we'll get to see, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is, if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina. Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, and marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where is it sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. If you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer, and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, more with more data over time.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots given what we're seeing recently.
Yeah, so we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Let's go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at, I'll just point you to the forecast. So. Inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down. And that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of. I would say the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates, and we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time, but when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie.
Hi, Chapo. I'm Julie Chabanas, AFP.
The mic is coming.
Oh, sorry. Thank you. Hi, Chapo. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, you know, as a factual matter, that's correct. We do need to see, you know, rents bottom out here or at least stay quite low in terms of their increases because we want the, you know, we want inflation to come down. And rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very, labor economics, and the labor market are utterly central. It's half of our mandate, so we spend a lot of time talking about that. I think, there are structural issues that are really not for the Fed, and so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk, now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So, we're trying to think where to start. I'll start with commercial real estate. Of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
That was Federal Reserve Chair Jerome Powell. And just to give an overview of what the Fed has decided today and what we just heard from Jay Powell, the Fed pausing rate increases, but did, through its summary of economic projections, also known as the dot plot, signaled 2 more rate hikes could happen this year. That's the average of the members of the Federal Open Market Committee, the policymaking part of the Fed. As we look at stocks here, it's interesting that, Akiko, we have seen obviously a little bouncing around, as we tend to do. An initial leg down, followed by a little bit of a bounce, and now we're sort of working our way a little bit back down again. But he made some really interesting comments in the press conference as well.
Yeah, and we also saw bond yields push lower. We were talking about them moving higher. Part of this is because as we think about going into this press conference, it was about this expectation of 2 additional hikes. We were talking about more of a hawkish bend coming in from the FOMC statement. But in the press conference, Jay Powell made it pretty clear there's still a lot of data to be had here. It makes sense to pause. He said he didn't want to call it a skip right now to see more of that additional data take shape. But there is a lagging indicator here when you think about where inflation is right now, where the labor market is right now. But he also said, I thought it's interesting. He was asked about the speed and level with which the Fed is moving here. He said, as we get closer to the destination, it's common sense to go a little slower. And the committee thought it was appropriate to moderate the pace. And he said it allows the economy to adapt a little bit more. So the market reaction we're seeing potentially, based on those comments, is July a live meeting? Yes, he's made it clear it's live, but I would argue, based on the comments that we got, you do have to wonder how much more time the Fed would like to have, how much more data they would like to have before deciding, yes, in fact, it's time to move another rate hike.
Yeah, there was definitely sort of a little bit of talking out of both sides of his mouth, right? It is a live meeting, but we're still going to be data dependent. We've seen services inflation. That's really the sticky part. That's the part that we want to see come down here. He has still said risks to inflation, though, are on the upside. And he also talked about that it'll be a couple of years before we see rate cuts, which is quite interesting. Because if you think even a month ago, the market was pricing in rate cuts by the end of this year. There is still a little bit of that being priced in, but obviously that's changing. I really liked a comment that I saw from money manager Cullen Roche on Twitter, which I will paraphrase. He said this is the sort of Chuck Norris effect. You threaten that you're going to kick somebody's butt so you don't actually have to kick their butt. And that's kind of the phase that the Fed is in now. We could see more rate increases, hoping that the rhetoric will tighten financial conditions enough and bring down inflation a little bit, or at least the rate of inflation, hopefully, that the Fed might not have to actually act. But we'll see.
And you
that
see the market
works.
reacting to that, right? I mean, in
Yes.
terms of how the Fed chair was talking. I mean, we sort of said going into this press conference, he's going to have to toe a very, very delicate line here so that the expectation is that there will be more rate hikes, but that the Fed is still willing to kind of look at the data moving forward. One more thing to point out before we get to our guest, he's sort of asked, why not just rip the Band-Aid off? Why this timing?
Yeah.
Why pause now? He said, if you look at core PC overall, you're just not seeing a lot of progress. So if you think about where the target is in terms of inflation, 2% has always been where it should be, 4.5% is where we're at. He's making it pretty clear that, look, we know that it's still elevated, but we don't feel comfortable in moving, at least in this meeting, because there's still a lot that needs to take shape from the 15 consecutive rate hikes that have happened.
Yes, he made it clear there's a lot that the Fed still doesn't know and doesn't understand about how long it takes for those hikes to make their way through the system. Let's get some more analysis on all of this, on the Fed's decision to pause rates and all of this discussion around it we've been talking about. Victoria Fernandez is with us now, Crossmark Global Investments Chief Market Strategist. Oh my gosh, Victoria, we're wearing the same color. First of all, great to see you, or at least a similar color. So what did you make of the press conference here? Do you think that this was a clear communication from the Fed chief? And if you do, what's the message he's trying to send?
Yeah, I don't think it was that clear, Julie. Otherwise, we would have a really good answer to that question. And I think the anticipation was that we would have a pause or skip, whatever word you want to use here. And then the July meeting, the futures would show for the July meeting probabilities going higher for a 25 basis point hike there. That's what the market anticipated. That's what we've seen priced into the market. So I didn't anticipate that the Fed would come out and do something different because they don't want to cause that extra volatility in the markets. However, at the press conference, I don't think we got a very clear answer as to what the goal was going forward. When asked why not just hike at this meeting, I mean, if I was on the Fed, I probably would have been someone that dissented and said, yes, let's go ahead and hike now. If we see that we are nowhere near our goal, if we see that things like rents, which he spoke about rent specifically. Remember, Julie, housing prices are moving higher. Housing prices lead rents. So it stands that rents should move higher. Inflation could go higher on the CPI number. If those are the cases that you're seeing and things are sticky, why not go ahead and make that jump now and then allow things to work through? I think they're going to take the 2018 vibe where they skip a meeting, they hike every other meeting. I think that's one of the ways as he talks about gradually getting to the end game. That's what they'll do. But there's not a clear story at this point, and I think they intentionally do that. So depending on the next round of inflation data that we get retail sales tomorrow, some of this other data that comes through, if it starts to change a little bit, they can adjust accordingly.
Yeah, Victoria, Julie and I were talking about this as we were listening in on the press conference. I mean, do you get the sense that in this press conference, the Fed chair essentially sort of walked back a potential July hike? I mean, he sort of suggested that there would need to be a lot more data. He talked about a full quarter of data. I mean, I'm looking at between now and the end of July when that next meeting is going to happen. I mean, a lot can happen in the next few weeks, but it certainly felt like he was sort of walking back that possibility in this press conference.
Yeah, I don't think he wanted to commit to that at all, right? So he was pulling back the idea of it's already baked in that we do that. But Akiko, look at the dot plot. It's telling us the median dot now is 5.6. So he can walk it back a little bit for the next meeting so that he doesn't have to be put in a box as to what they're going to do at the end of July. But it seems like the committee as a whole is telling us, look, we've got 2 more rate hikes to go to get to that median dot. And so the words don't really match the dots. And I know they always say these are just projections, don't put a lot of weight into it, but people do. And you guys made a Chuck Norris reference a moment ago. And I think the difference is, look, you look at Walker, Texas Ranger, and he had a lot of credibility in what he said he was going to do. I think here at the Fed, people may rely a little bit more on the dot plots with the credibility than on what Powell is saying. I think it's why we initially saw yields move up a little bit. They came back down a couple basis points, but I think we're still higher than where we were at the beginning of the day and why we've seen so much volatility in the equity market. So maybe a potential pullback there, but the dot plots are telling a different story.
All right, so Victoria, put it all together for us. What do you do strategically with equities right now? And does what happened today change anything for you?
It doesn't change our outlook at Crossmark. And I think that's because the way we've been approaching this market is that we actually thought that the Fed might do more rate hikes, right? We look at what we're seeing in the marketplace, and we're not seeing inflation come down far enough. Now, if the Fed had come out, Julie, and said, we're going to move our target to 2.5% or 3%, then that's a different story. Then maybe we get a little more bullish in the market and we do a little more high beta stocks. But right now, we're really trying to have some diversification. You have to have exposure to some of those high beta names, but we also think it's really important because we do anticipate having a pretty good pullback at the end of this year, mild recession, whatever we want to call it, that you need to have some of those other names, some more staple names in your portfolio to mitigate that. So really doing a balanced portfolio with our clients. We're also being data dependent. That could change, but for now, that's our approach, and we think it will bode well as we go through the end of this year.
We're all just data dependent in this world. Victoria Fernandez of Crossmark, thank you so much. Good to see you.
My pleasure.
Worth recapping here, the Federal Reserve unanimously deciding to pause rate hikes today. However, pointing to the likelihood of more increases this year as officials continue to battle elevated inflation. Let's head out to Yahoo Finance's Jen Schomburger, who is at the Fed for us. We were just listening to the press conference here. Jen, you were there as well. Certainly the Fed chair trying to keep all options open with the expectation that there are 2 more rate hikes to come this year.
Hey there, Akiko. That's right. Fed Chair Powell saying that the Fed has not made enough progress on inflation. It needs to come decisively lower. And that's why the committee sees 50 basis points more of rate hikes here. Take a listen.
Nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy.
Powell said the committee did not make a decision on what will happen next meeting, nor has the committee adopted a every other meeting strategy. However, he said July will be a live meeting. He says the main issue now is determining how much more tightening is really needed. He says risks to the inflation are to the upside and that a rate cut would not be appropriate this year given little progress made on inflation. He says the level of interest rates now is consistent with what was seen pre-banking crisis, but now it's really a question of speed versus the level on the actual interest rate. He says we've gotten to a point where we're fairly restrictive, but now we can afford to take a step back and see what the lag effects are, see how our policy permeates through the economy. So that's why he thought it would be important, or the committee believes it would be important, to moderate rate hikes at this juncture, though he did note we still don't know the full extent to the credit tightening that we saw from the bank failures earlier this spring. It'll be interesting to see how the committee takes that into consideration as we approach July. Back to you.
Jen Schomburger, they're live for us at the Fed with the big headlines there. Appreciate all the reporting there.
And joining us now with more, Julia Coronado, Macro Policy Perspectives President and founder, and a former Fed economist. Everybody's wearing this color today,
only
Julia.
one without red.
I know, red. I was just noticing that.
We're all jazzing up for the Fed today. I'm not sure if Jay Powell quite rose to the occasion as well. I mean, basically, it feels like at this point anything could happen, Julia. I mean, the July meeting is live, but they're going to wait and see what the data shows. We might have 2 more rate increases by the end of the year. There probably won't be another couple of rate hikes until for the next couple of years. Like, what's the bottom line here?
Yeah, the message is pretty garbled. You've raised your outlook for growth and inflation, but you're pausing. For him to cite that the Fed funds rate is back to where they thought it was might need to go before the banking crisis suggests he doesn't expect the banking credit tightening resulting from the banking turmoil to weigh heavily on the outlook, but that's a key source of uncertainty. So it seemed to mainly be about a couple of things for me. One, slowing the pace. He said that a bunch of times. We're slowing the pace, which is just a way of sort of injecting, a little, just, taking into account some of the uncertainty as they come into that peak rate. And then the other thing is to hold the threat of rate hikes over the market for longer. I mean, if you think about, putting 2 hikes in the baseline essentially takes us through year end. at this new slower pace. So they're not going to cut rates this year. That's been a message that they have been saying, but now this really puts, kind of an emphasis on that. Stop it, markets. We're not going to turn from rate hikes to rate cuts very quickly, and it's really not in the cards for this year. So in some senses, but if you look at the skew of the dots is below the median now, whereas in March it was above the median. So that's the baseline is 2 hikes, but there's more people who think that they'll do 1 or they're already there than think that they'll have to do more than 2. So, that kind of adds a little bit of a flexible tone to this otherwise pretty hawkish message.
Yeah, Julia, I sort of feel myself sort of swaying back and forth with what we've heard from the Fed. But let's work with the expectation now. If the expectation is 2 additional rate hikes, and you look at where inflation is right now, yes, we are more than double where the Fed would like it to be, at well above 4%, but we have seen the prices come down. We have seen a cooling here. Does it make sense to look at additional hikes, 2 additional hikes by year end, considering where the data is right now?
So I think Powell's answer to that question was about, how often they have had head fakes on inflation and how often they have been wrong, and that they really need to see more decisive evidence. We think they're going to get it. We don't think they'll go 2 more times. We think they'll go once more. But, there are a lot of leading indicators pointing towards cooling in core inflation. Obviously, headlines already cooled. That's one leading indicator. Also, used car prices and shelter. He talked about a lot of these dimensions, but they need to see that materialize. And so I think if they do see it materialize as we expect, they will be more flexible. And they don't seem like, again, the skew is towards less, not more. So, if they actually get more moderation in inflation by, say, November or even September, maybe they'll take that hike out of the baseline in the SEP, or keep it and then just skip it in November or December. So we think the stars are aligning, but again, they really want that confirmation in the data, and they still seem a little bit scarred by being behind at the beginning of this inflationary episode.
Julia, it was also interesting what Powell had to say about the labor market. Obviously, that's more lagging indicator, but even there, he talked about signs of progress. Let's play what he had to say, and then I want to get your reaction.
There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation.
So, again, here it's sort of a balance, if you will, but it does seem like all signs point to progress towards the Fed's goals, right?
Yeah, absolutely. And by the way, that progress in the labor market is coming from a source that they had already counted out. They basically had said late last year they didn't expect any improvement in labor supply, yet we've gotten substantial improvement in labor supply this year. So, that's been definitely an upside surprise. He's acknowledging it, though he's still calling the labor market very, very tight. So, again, swaying back and forth. There is a little bit of a mixed message here, but yes, a lot of things are showing their policy is tight. The economy is moderating. It's coming into better balance. Leading indicators of inflation are cooling. The composition of inflation is optimistic, points to some optimism. The labor market looks really nicely soft landing so far. We've gotten moderation in wage growth without a rise in unemployment. This couldn't be better news for the Fed. But again, they just really want to see more convincing cooling in inflation itself, in the core measures of inflation itself. And again, if they get it, I think they're going to be perfectly happy to be more flexible here.
Julia, it seems like, at least on financial Twitter, that Powell is getting a lot of criticism over saying, skip, oh, I shouldn't call it a skip. And, you know, we go through this song and dance every time where his language is really scrutinized. And I guess on the one hand, you should say, well, he should know by now. But on the other hand, maybe the market should know by now. Like, who's the problem here? Is Jay Powell and maybe imprecision the problem? Or is the problem that we are parsing his language too obsessively?
You know, I think the problem is that you've got a big committee with mixed views. And when the chair gets up at this press conference, he has to do his best to strike the balance and represent the totality of the committee. And so you can get some garbled messages from time to time. This was, you know, one of the reporters asked, what's the narrative here? You've raised your outlook and yet you've skipped the meeting, but you've added more hikes. You know, what are we supposed to make of all of this? And, you know, there's no really great answer other than, you know, clearly the banking crisis is at the heart of their decision to skip. Had we not had the banking crisis and we had had the same flow of data, they probably would have gone. The fact that there is a lot of uncertainty around that, and then there was the debt ceiling, and now there's the restoration of Treasury funding after the debt ceiling. There's just a lot of things that led them to decide to just slow things down a bit. Every time he's sped things up to like throwing 50 basis points in the mix, things break. So, you know, going slower allows them to tighten things a little bit more gradually and flexibly. And yeah, it's kind of a mixed message, and it doesn't all add up. And I think what we need to acknowledge in all fairness is that we're just in the middle of this extraordinarily uncertain time. Just think about how many mood swings we've had in the market so far this year. From hard landing to soft landing to, oh my God, inflation is coming back and the Fed's going to need to hike faster, to, oh my goodness, we're, you know, in a banking crisis. You know, it's been wild. And so formulating a baseline forecast and even evaluating the risks around that forecast is challenging. And then when you're talking about 18 different people doing this and then communicating a coherent policy message, you know, sometimes it gets a bit muddied.
And potentially, you know, expect to experience more mood swings between now and the end of July with the next FOMC meeting takes place. Julia Coronado, it's good to have you on today, Macro Policy Perspectives President and Founder.
Thank you for having me.
Well, coming up, we are going around the horn and checking in on some of the top trending stories of the afternoon. We'll be right back.
All right, let's talk more about the Fed and get some reaction from Yahoo Finance's Ali Canal and Josh Schaefer on the breaking Fed news. Josh, you've been looking into reaction from the street so far and from, I don't know, a FinTwit. I don't know what you're looking at. Tell us what you're
just taking a
looking
look at everything out there. Normally, I would say the biggest takeaway is that there's a strong takeaway, right? And that's something that we don't necessarily have today. You go back to last Fed meeting, it was hawkish pause, right? Almost every economist, every analyst was writing hawkish pause. That's what today's message is. And we're not really getting that clear message today. But some of the ones I did want to highlight that I thought were interesting, we had Pantheon Economics pointing out that they think that this move today was essentially pointless. That was a strong take, but I thought it was interesting because basically what they're saying is the Fed won't get enough data in the next month if they are going to hike in July. What's the difference between just not doing it now, hiking right now, and then waiting, maybe you hike again in September, essentially saying that what Powell has said about monthly data not being as reliable isn't good. Then you take a look at what Oxford Economics said. I really thought this one was interesting. They called it a bluff, and specifically referring to the dot plot. And I think what they were referencing is once Chair Powell started speaking, the dot plot kind of did seem like a bluff in some ways, right? Because the dot plot seemed to indicate we're definitely hiking more. And then once he started speaking, he sort of backed off that a little bit, and you saw that reaction in markets as well as we saw a little bit of a rise in stocks.
I mean, it was down as nearly 400 points, right? Initially on the statement, and then the Fed chair starts to speak, and then it's sort of, well, which way is it going to go? And this kind of gets to the point that we were talking about with our earlier guest, which is you had the statement, and then you had the Fed chair come out, essentially felt like he was sort of walking back a July hike, even though he said it was live, because when he talked about what he needed to see in order for another hike, it just doesn't feel like you're going to get that between now and the end of July.
Yeah, he said, don't call it a skip. That was one of the quotes there.
He said, I shouldn't call it. He said, skip. Well, I shouldn't say skip.
Right, exactly. And like we've been talking about, he said there is credible evidence that inflation is coming down. He said much of the tightening took place summer and the end of the year, so he's comfortable pausing rates at this point and stretching it out a bit to have a bit more of a moderate pace. But at the end of the day, he said the risks to inflation are still to the upside. And in terms of any potential cuts, we're not getting that for at least a couple years is what he signaled. So definitely not in 2023. The Fed dot plot showed that as well. So you have to be a little curious where he's going with this. I know you were just speaking with your last guest about what the narrative is here, because there just seems to be this
Ali, I
messaging.
just got a note in from Bank of America, too. Their economist team now saying they don't see cuts until May 2024. And Julie, I know you were highlighting this earlier. We were talking a lot in May, like 2 or 3 weeks ago, about cuts coming at the end of 23, right? And it seems like that conversation has basically just ended. I know Powell said that they're not considering it right now, but even economists who obviously project different things than Chair Powell were talking about cuts in 23. And it seems like that conversation is really starting to end here. I should note B of A also saying they do expect those 2 more hikes to come in July and September. That's their forecast right now. So interesting to see.
Yeah, the market had been pricing in those cuts, and the Fed kept saying it's probably not happening. Now they're like, it's really not happening, guys. And the market's finally gotten the message here. So, Ali, talk us more about what about these dots that we
the dots. This is part of the summary of economic projections, which the Fed comes out with their forecast for types of indicators like GDP, unemployment, inflation, and of course, interest rates. So this is what we have here. And as you can see, interest rates are expected to continue to be high in 2023. I want to go and focus in on what we saw this year. So if we go to this handy dandy drawing here, we'll see that most FOMC members, each dot represents a member here. They see interest rates peaking at 5.6% this year. Now that's higher from the March projection of 5.1%. So that does suggest that the Fed is going to raise rates 2 more times by 25 basis points, or perhaps 1 time by just 50 basis points here. We see 3 members expecting rates to be closer to 6%. But again, no members at all are expecting that rate hike. Now, if we take a look back at the longer term projections, they do anticipate that interest rates are going to come down to 4.6% in 2024. But you can see there's more dispersion here the longer that we go, because the longer you go, the difficult it is to predict what will happen. Now, I did mention some of those other economic indicators. So let's go with the Fed's projections for core PCE inflation. That's consistently very important for the Fed. We see that at 3.9%. That's higher than the March projection, but we the Fed at least does expect inflation to cool to 2.6% in 2024 and 2.2% in 2025. Then if we go to the unemployment rate, that's showing an improvement here over March at 4.1%, but it is expected to tick higher to 4.5% in 2024 and stay at that level through 2025. And then finally, GDP. Now, the Fed does expect slightly stronger economic growth at 1%, and then we get a little higher as we continue to go. So a lot of data points here, but again, this is all just a forecast and we don't exactly know what will happen until we happen, which seems to be the message.
Can we go back to the PCE one for 1 second? Okay, so here is what's nuts. Why is their target still 2%?
Yes.
Right? Why do
Gotta
they
move
not?
up at some point.
Why don't they change their inflation target at this point? It just doesn't make any sense. This is this acknowledgement.
Yeah. Even 2025.
They're not still going to be raising rates at that point by their own forecasts.
But we're still above the 2%
They're still
mark.
above the 2% mark for the next couple of years. So it just seems out of step with reality, that particular part of the forecast, to not bring it down.
And Powell said that was a very important thing and that the committee would be doing everything they could to get to that 2%
Well, so,
inflation.
you know what's interesting is I'm sort of thinking this through in my head because watching the press conference, I felt like I was getting swayed on both sides about what exactly the Fed's next move is. But if you think about where core inflation is, well, above 5%, the Fed can't not come out and say, yes, we're going to do more because the target is at 2%. I did think it was interesting, though, with our last guest who said it really is all about the stresses we're seeing in regional banking, which is why this meeting specifically they chose to pause, skip, however you want to characterize it. He was asked about that, but didn't really, I mean, he talked about the tightening credit that he's seeing around the banking system, but didn't necessarily address how that played into the thinking of this.
No, he deferred, right? He said it's too early to tell.
Yeah.
And so that's why you pause. That's maybe how you read some of the pause, right? Because he said it's too early to tell. Essentially, we need to wait and see. So maybe that's what they find out over the next 6 weeks? Maybe
And then he
get a
was
little more
asked,
info
what
there?
if nothing changes?
Right.
What if the data doesn't change? If another 6 weeks have passed, do you go ahead and move anyway? And he said, no, we're data dependent. I don't know.
It's like you just have to throw your hands in the air at some point because we're not going to know until we know is the takeaway that I got.
We're not
going to know until we know.
Okay.
We'll be back in July then.
Yeah. Okay.
That gives us enough to talk
Appreciate it.
about between now and the end of July.
Yeah.
We'll do another roundtable.
I love it.
do it.
All right.
Let's do it.
All right. Coming up on the other side, regulators cracking down on Google for breaching antitrust rules. More on that story when we've got Yahoo Finance returning on the other side of the break. We'll be right back. Well, we've been talking a lot about the rapid advancement of artificial intelligence lately, and our next guest says he's using the technology in his recently launched ETF DIP, focusing on buying the DIP investment strategy. Joining us now is Ryan Paddle, Kaiju ETF Advisors CEO, for this week's ETF report, sponsored by Invesco QQQ. Ryan, it's good to talk to you today. Talk me through how this works, because, machine learning has kind of been integrated in ETFs for several years now, right?
Well, in terms of as a filtering mechanism, if you're looking at the AI's ability to crunch large amounts of data, yes. But in terms of making the endpoint investment decision, no, we haven't really seen that so far. I think there's, a gulf of trust that still needs to be crossed when you talk about AI making decisions of consequence on behalf of humans. We've all played around with ChatGPT, and maybe it's, written a funny dinner invite for you or done some light lifting in your business. But, would you trust it to write the closing statement in a trial in which you were defending yourself? Would you trust it to write your character reference letter for a job that you desperately wanted? Probably not. And so when you add an element of jeopardy into the mix, then people's faith in a new technology tends to sort of fade away, and it's going to take a little while to cross that bridge, I think.
Yeah, and exactly on the legal point, I believe there was just a situation where someone used ChatGPT to write a legal brief, and there were fake cases that were cited in that brief. So just an example of that. So how does this then work in your case, Ryan?
Well, in our case, we're really leveraging the full capability of AI to do a very specific thing. So, areas in which AI is not well suited at this point in time would be, say, managing a global macro fund. It's very difficult for a system that doesn't understand context to estimate what the fallout of a geopolitical decision would be on the regional or global economy. But when you're talking about dip identification, you're talking about something that's highly technical in nature. And when we talk about dips, we're not just talking about any stock that's sold off, and which is sort of the general retail take on buying the dip. We're talking about artificially oversold stocks. So that is something that has experienced perhaps liquidity void. It's been predated upon by HFTs. It's been pushed below its near-term fair market value, and there's generally a mean reversion that occurs. And prior to that mean reversion, these stocks exhibit specific behaviors that the AI is able to identify. It's very short. There's a lot of data that needs to be analyzed in terms of making that determination in a short period of time. It's something that AI is really well suited to. So that's how this is working. It's predating on those low to high mean reversions, largely in S&P components.
What does that behavior look like, and why do you need AI to do it?
Well, it's going to have a specific volume compression signature is largely what we're looking for. We look for a number of different criteria. Obviously, we're probably not going to share the secret sauce behind it all, but it's specifically quantitative in nature. It's not something that's a result of a bad piece of PR. It's not a result of a miss on an earns report or something like that. It's literally a systemic mechanical outcome that occurs, just very short term. And again, we're not trying to time the market. We're not predicting that this mean reversion will continue in any meaningful way. It's just literally the dip that we're catching. And then, we're there for about 1 to 7 days. The average is 3.
Ryan, thank you so much for breaking it down for us. One of the many interesting ways that people are playing with AI right now. Appreciate it.
My pleasure. Thank you.
Coming up, almost time for the closing bell. We've got you covered with more market coverage on the other side. We'll see where we end up after the Fed. We just have the closing bell on Wall Street. So let's take a look at the market action. You can see Shell ringing the closing bell there, but we've had a lot of bouncing around in today's session in the wake of the Federal Reserve decision to hold interest rates where they stand after 10 interest rate increases, and to indicate maybe they're going to keep going. If you look at the summary of economic projections, aka the dot plot, 2 more rate increases or 150 basis point increase being projected here. But as Jay Powell made clear in the presser, anything really anything could happen. But right now it looks like we're closing up in the S&P and the NASDAQ, and that the Dow is trading a little bit lower. But let's take a look at some of the individual top movers of the day, because there were other things going on, of course. And one of the biggest things going on was the absolute bloodbath happening in the health insurance industry. And this is, by the way, this is not an area where we tend to see this much movement. United Health warning of rising costs as a result of an increase in surgeries among older adults. So not only did it fall, not only did Humana fall, but like anything touched by health insurance, and in particular Medicare and Medicaid, falling in today's session as a result of this commentary.
Yeah, here's a number to keep in mind. $42 billion wiped out from the market cap.
Jeez.
Given what we saw there today. And you talk about Humana down well over 10%, as well as other Medicare, or at least we should say healthcare providers as well. I mean, some of this is about surgeries that were delayed during the pandemic. We're talking 3 years later now, but certainly just an ugly day.
Yeah, the other number that people have to keep in mind when you're talking about the insurers is something called the medical loss ratio. How much of the premiums that we take in do we pay out to cover what people are, the operations and such that people are having? And for United Health, it's 82.1% to 83.1%. They said the higher the number, the worse the number, right? So they said that it might be at the higher end of those estimates. By the way, what's been bad news today for the health insurers has been good news for who they're paying that money to. Medical device makers, hospital chains. We actually saw shares of those types of companies go higher on the day. Look at these, all of them trading higher. Stryker, Boston Scientific, Medtronic, Intuitive Surgical, all of them climbing on the perception if there are more surgeries and the health insurers are paying more, these are the guys getting the money.
Interesting to see that correlation there. All right, let's talk about Affirm shares sliding after BTIG initiates coverage on the stock with a bearish tone, noting the company's business model is under pressure as, in their words, we enter a new stage in the macro environment where discretionary spending is tightening quickly. This is an interesting one for me, because you could also argue on the other end that as discretionary spending really gets tightened, you don't have as much money to use, wouldn't consumers go and really maybe extend their purchases to buy now, pay later?
I think that there's also the concern about expense growth, though, as a result of that, right? If you have and Affirm, the management of Affirm has been very careful to say that they do not lend irresponsibly. So we'll see kind of what that balance looks like. I mean, this note was interesting overall because it's an initiation not just of Affirm, but of the financial technology industry as a whole. And they like SoFi and say it's best positioned to succeed in this environment because they see them as more diversified, right? Affirm, a little more narrow in its scope, right? SoFi offers a bigger suite of services, but I just thought that was an interesting contrast in this note as well, that one would benefit more than the other, but we'll obviously see what happens. And shares of advanced micro devices edging higher. That's after Amazon Web Services reportedly considering using AMD's new artificial intelligence chips. That is according to Reuters. The shares of AMD trading up by about 2.25% today. Although you also saw a lift in tech overall. Yes,
NVIDIA hitting another high.
Yeah, so it's unclear to me how much of it is enthusiasm over this report.
Well, again, this is a report, we should point out, not necessarily confirmed yet. It certainly would be significant to have that partnership in place. But if you look at the moves in a stock like NVIDIA, that points to what we've been hearing over and over from analysts, which is to say that AI is such a huge opportunity. There's just enough to go around. It's not about one winner in NVIDIA, another winner in AMD. There's plenty of opportunities out there, but this would be certainly significant because NVIDIA has been the leader, especially on the data center side of things.
Yeah.
And if this partnership is in fact true, that's a big one.
Guess what, though? That's another record high, record close for NVIDIA today. Another one. All right, for more on this potential team up, let's get to Yahoo Finance's tech editor, Dan Howley. So, feels like AMD needs a win here.
Yeah, look, I mean, the thing for AMD is that their server side has been doing better for them than obviously the general computing side, the CPU side of things and the GPU side of things for consumers, just because of that drop that we saw in overall consumer spending. Businesses don't need computers right now. People don't need computers right now. It's starting to change, but the comparisons to during the pandemic were wild for them. So same thing went with NVIDIA, but NVIDIA also could lean on that enterprise side of things to really boost them. What we're talking about here is a new AMD chip that would basically rival the best of what NVIDIA has to offer. The NVIDIA chip is the H100. This is called the AMD Instinct MI300X. Not as fun of a name as NVIDIA's H100. But the big deal here is they say it's the world's most advanced accelerator for generative AI, and they're obviously banking on that generative AI craze, really pushing that forward. And they're doing it alongside NVIDIA, obviously. Both companies are saying, hey, if you guys are going to talk about generative AI, we'll do it too. Let's go. So this is a big deal for AMD in that they're now able to say, look, we can play in the same space as NVIDIA. Usually what they do is they undercut competitors. Generally AMD can be cheaper than an NVIDIA or an Intel for that matter. So that could be more appealing to enterprise customers. The other thing, and a lot of people point this out when it comes to NVIDIA, is they call them a full stack offering. Basically, they have the chips and they have the software and everything behind that they're able to then offer to enterprises, which can then work on their own kind of algorithms and large language models for generative AI at least. AMD now doing that as well. They have the MD Instinct platform. That's going to be the platform is not the MD Instinct. That's a slew of MI300X accelerators.
That's a lot of numbers.
A lot of numbers, a lot of wild names going on here. Bottom line is they're offering the same kind of software that NVIDIA is as well. And so by doing that, they're able to say to enterprises, now you can do what you only could do prior on NVIDIA stuff with us.
You have options.
So, I mean, it's a very big deal for AMD. I mean, the question to me is how long is the bonanza for AI going to last?
Well, and just quickly here, Dan, when NVIDIA came out with its new suite of products, it said, here are our customers. Here's the revenue we're getting from it already. We haven't heard that. We don't know who's buying this chip yet, do we, from AMD and this suite?
I mean, the potential is that it would be Amazon, but that's according to the Reuters report, so we don't know for sure. I think the broader thing is, and as I was saying, is, where does the AI conversation go from here, right? Yeah. For these companies, yes, there are still opportunities for AI sales. There's still opportunities for cloud sales, right? We've been talking about the cloud forever, but not every company has cloud infrastructure yet. So the same deal goes for AI. I think, and Kiko and I were talking about this before, and we've talked about this before, Julie, that, this is, the hype is all generative AI based hype, right? You have AI in everything. We're using AI. I mean, these cameras move on their own to a degree. So there's AI involved in there too. So it's not as though AI hasn't been around for a while. It's that it's the generative AI. People are hyped on that. You can't tell if this is actually just because we're seeing different stocks rise, but NVIDIA high, people clearly, I guess, not worried that it'll be a problem for NVIDIA at this point. They do control the vast majority of the market, though.
Yeah, we'll see. All right, thanks so much, Dan Howley. Appreciate it.
Well, EV stocks joining AI names and leading the stock market rally, driven by Tesla's 13 straight days of gains. But that record just broken with a modest decline today. Let's bring in Yahoo Finance's Inez Ferre for that. Inez.
And guys, speaking of AI, investors have been piling on the EV stocks lately. Part of that having to do with that craze because of AI. I'm going to pull up a 10-day chart so you can see here Tesla up 25% over the last 10 days. In fact, year to date, this stock is up a whopping 108%. Part of this has to do because of AI. Adam Jonas over at Morgan Stanley writing a note recently saying that investors Investors are thinking of Tesla first as an AI company and second as an automobile maker. But nevertheless, he points out, look, there's a big difference between some of the products that Tesla is building, like autonomous driving, that type of AI, and generative AI. Difference there. But nonetheless, investors really are piling on to these stocks recently. I also want to note that investors have been anticipating that the Fed would indeed pause its rate hikes. And remember that high rates are terrible for growth stocks, for companies that need capital, that need cash, because the cost of capital is more expensive with those higher rates. So in anticipation of a Fed pause, you saw names going higher. Also, China's central bank has slashed its short-term rate as well. So that gave a boost to some of the Chinese ADRs like XPeng, like NIO as well. Li Auto also over the last 3 days is up as well. And then I just want to point out what's been happening with Nikola. The past 3 days up 53%. Remember that this stock hit an all-time low of 52 cents on June 6th. And in fact, just last month, you had the NASDAQ that warned Nikola that it could be delisting from the NASDAQ because the stock had been closing under $1 for the past 30 consecutive business days. Nikola seeing a big rally as well.
Wow. 53%. That is pretty incredible to see. Inez, thanks so much for that. Well, coming up on the other side, mortgage applications seeing a boost in demand. More of our week-long series, Real Estate, the New Reality, when we return. We'll be right back.
European regulators are suggesting that Google calm its concerns over unfair competition by selling part of its ad business. The regulators issuing a report saying that Alphabet, Google's parent company, appears to be breaching antitrust rules. Google now faces regulatory challenges on both sides of the Atlantic. With more on this is Yahoo Finance's Alexis Keenan, and Dan Halley is back with us. Alexis, first of all, what does this EU report mean exactly? What are the implications?
Yes, so this is a preliminary report by the EU's antitrust regulator, the European Commission. And what they're doing is they're putting Google on notice to say, we don't like your ad tech business. We think it violates European antitrust laws, and we would like you to divest some of the businesses that you have in that market. They say that Google is using its dominance in that market to unfairly participate in the place where publishers and advertisers converge to buy and sell advertising online. They also, I want to note that the U.S. is also charging Google with a very similar violation of antitrust laws. So the company is facing this problem on both sides of the Atlantic now. Google, of course, not liking this measure. It's a huge revenue stream for the company. It responded by saying that the EC's investigation focuses on a narrow aspect of its business and that it's not new. The company's spokesperson went on to say that the company will oppose any measure that the EU takes to try to make it divest any of these businesses, and it would push back in that regard. Now, the EC report for the actual words on the paper there, they go like this. They say that the EU's preliminary view is that only mandatory divestment by Google of part of its services would address its competition concerns. And it says that this alleged self-preferencing that they say that the company is engaging in possibly harmed Google's competitors, also publishers, as well as driving up advertising costs. So those are the main concerns there. But this is a preliminary step, possibly one to start opening up negotiations with the company if it will do so.
So it's a preliminary step, but Dan, we know the EU has been the most aggressive, especially on regulating big tech, specifically American tech. What does this mean in terms of the pressure Google faces back home here in the US? And ultimately, to Alexis's point, it is the big revenue driver for the company.
Yeah, I mean, in their statement, the European Commission basically said that they're working with the US, the DOJ in particular. So, obviously there's a close relationship. And then they went on to mention some of the member countries that they've worked with to get data on this. For Google itself, the breakdown is astonishing. Google advertising in 2022 accounted for $224.5 billion of their $282.8 billion in total revenue. So, it's a massive, massive amount of money that they depend on for their advertising business. The rest is, stuff like Google Cloud, other bets, things here and there. But it's basically pennies compared to what they have as far as the advertising business. If they're forced to break that up, I mean, you can only imagine what that would mean. It also, is worth pointing out that Facebook is one of the largest advertising companies in the world as well, or platforms that companies use. So could help build up on Facebook's kind of power in this area. I think that's something that's worth mentioning.
I don't really understand what Google is allegedly doing wrong here. Can you explain to us?
Yeah. So essentially what they are is they're saying that they're acting as all three pieces of a kind of buy and sell scheme, right? Not scheme as in a negative, just how it works, right? So they're saying they're working for the ad buyers, the ad sellers, and then the intermediary where that buyers and sellers exchange to see where ads get placed. And so because they're able to do this, they say that they were self-preferencing themselves, able to offer better bids than they would get publishers would see otherwise or advertisers would see otherwise. And so because of that, they're saying that's really where the issues arise and why they shouldn't be able to continue to operate in this manner. So, it's interesting when you see it laid out in the chart. The European Commission had sent one out, and you look at it and you're like, oh, whoa, that doesn't look right. So, I mean, and then they go into discussion about how Google's able to change things here and there and make it look maybe kind of not necessarily obfuscate, but make it look better than it otherwise would be presented. So when you see it laid out like that, it's kind of stunning to see.
Well, and you have to wonder, to your point, Facebook, Meta, Amazon, I mean, they're all watching this closely to see what this means for their operations in the EU. Let's talk about what's happening here in the US. There's another company that could be dealt a huge blow here, and we're talking about this acquisition of Activision Blizzard by Microsoft. What's the very latest there, and what does it mean ultimately for how this could all be resolved?
Yeah, so a federal judge has basically said that the idea here is Microsoft wants to buy Activision Blizzard. There was worry at the FTC that they would go ahead and do that, complete the acquisition prior to the FTC being able to work out their lawsuit against Microsoft trying to block the deal, right? So they went ahead, FTC, and talked to a federal judge, filed their suit, said, look, we want to be able to block Microsoft from being able to complete this acquisition. before we have our own say. And so this basically means that Microsoft is on hold until then, and we'll see whether or not they can go ahead and complete the acquisition or not prior to the FTC when the case is taken up later this month. But, you know, for Microsoft, it would be their largest acquisition. $70 billion would mean that they would get the whole of Activision Blizzard's IP, and it would make them the third largest video game company in the world by revenue. So a lot goes into this. You know, the EU is okay with it. The UK is not. Other countries are okay with it. So it seems like it's dividing a lot of opinion.
So the big thing here to watch, though, is next week, and that is on the 22nd and the 23rd of the month. The judge in this case is going to hold a hearing to decide whether a more permanent injunction, it's called a preliminary injunction, but should an injunction block this deal from going forward while the FTC figures out what it wants to do on an administrative level. That's outside of the court. That's being handled by an administrative law judge. So that is the date. If the judge decides after that hearing that this deal is going to be blocked during the pendency of that review, then the lawyers that I have talked to in this space, they say, then you should better expect that maybe this deal is now off the table. So we'll be watching for that.
Interesting. All right, mark your calendars, June 22nd, 23rd. And thank you so much, Alexis and Dan. Appreciate it.
Well, mortgage applications are seeing a boost in demand coming after recent declines in mortgage rates. Application saw its biggest weekly advance in 3 months, increasing 7.2%. But the issue with housing affordability is far from over, leaving more room for housing demand to improve. In this latest installment of our week-long series, Real Estate, the New Reality, we are taking a deeper dive into housing construction in relation to the push and pull of supply and demand dynamics. Let's bring in Chris Porter, John Burns Research and Consulting Senior Vice President. Good to have you on today, Chris. So walk us through what that supply-demand dynamic looks like right now.
Yeah, I mean, we've got some pretty strong demand for housing. Obviously, people want to, they've got to live in a house, right? And we've got a growing population. The challenge is just the supply is not there, especially on the resale side. We are at a very low levels of resale supply. And, you know, I think that's actually created a bit of a floor on how far prices could fall, at least temporarily. And also, it's given some more market share to the home builders. The new construction has really kind of been able to step in and represent a bigger share of the inventory available for sale. And that's why you see, you know, the builders doing quite well right now.
And so I believe it's by your calculations, we need 17.1 million more new homes over the next 10 years to meet the demand. Are we going to get those houses? Are we going to actually see that many be built?
So the affordability plays into this in big ways. And you know, that's under sort of normal affordability conditions. We are still not in normal affordability conditions right now. People are still paying a greater share of their income towards housing than they have historically. And the way that you bring affordability back into check is one of three ways. You either raise incomes, you lower mortgage rates, or you lower home prices. And we really haven't seen prices come down all that much. That differs by market, obviously. Incomes are still growing pretty solidly, but mortgage rates remain, you know, high, and that's been a big challenge in housing right now. Where the new home side has been able to benefit from that is by offering some of these rate buy downs and getting buyers in at lower rates.
How quickly does that supply need to come online in order to bring those rates down, and how do we get there?
You know, I think once rates start to fall, and we think they will. I think we're not going back down to 3% rates anytime soon. And I think that was indicated today in the Fed announcement that, you know, we're not going to see the Fed funds rate come down anytime quickly. And, you know, I think mortgage rates are going to stay elevated beyond what people have been used to over the last several years. And so what it's going to take is to get the demand, to get the construction there. I think the demand will play out over time, but we're probably going to see less household formation in the short term until people can feel affordability is in their favor and they can purchase a home.
Do we also need to fundamentally reset our expectations of what home ownership, what percentage of Americans will end up being homeowners?
You know, I think it's interesting. So you've got sort of two ends of the spectrum here. You have this massive wave of older adults who have 80% home ownership, and that's a number that's getting bigger. As older adults age into their later years and very high home ownership it's the younger adults that have that lower homeownership rate today. We've seen a little bit of an uptick in the last couple of years amongst the younger adults, just as they had more money in their pockets through government stimulus, as mortgage rates were sub 3%, many of them were able to get in. But I think with rates staying high, it's going to be a challenge for homeownership to rise in the near term until that affordability measure gets a little bit more into check.
Well, and to add on to that, if you talk about supply, we talk so much about single family homes, single family units, but it really is about multifamily units as well, sort of becoming increasingly the only option for any kind of ownership. If you sort of look down the line on where things have been moving, what does that mix look like?
Yeah, so I mean, think about it. It's about 2/3 single family, about 1/3 multifamily in terms of the new construction. We've got a lot of multifamily in the pipeline right now that's delivering to the market. I do think we're going to see a bit of slowing in multifamily over the next several years, and we do think that single family will probably won't slow by as much on a percentage basis here in the next couple of years, as we have this group of millennials that's moving into those years where they're purchasing homes in bigger numbers, and even that Gen Z group moving into those home buying years. We're seeing more shifting towards that single family, and so we'll start to see that balance probably remain about the 2/3, 1/3 split, but certainly we've got a lot of multifamily coming online right now.
Chris Porter, John Burns Research and Consulting Senior VP. It's good to talk to you today. Appreciate the time.
Thank you.
Well, coming up, Secretary of State Antony Blinken finally heading to China after that spy balloon controversy. We look at the implications for U.S.-China relations on the other side. We'll be right back.
The price at the pump is coming down, but other energy prices are finally dropping too. For more on this, let's bring in Yahoo Finance's Rick Newman. Rick, what are we talking about here?
We're talking about electricity, natural gas, call it household energy, if you will. Gasoline prices obviously get all the attention because of those giant signs at every filling station. Probably nobody except commodities geeks know what the price of natural gas is at any given time. I won't put you guys on the spot and ask you if you know, but nobody buys natural gas directly. However, the price of natural gas basically determines your utility bill. And utility bills have skyrocketed during the last couple of years. Just to give you a sense of natural gas, right now, natural gas prices have come way back down. They're around $2.40 for 1 million BTUs. That's how it's priced. That price was above $6 or $7 for much of 2022, and it peaked above $9. So right now, natural gas prices are at about 1/3 of where they were at the peak last August, and that's great news for consumers as we're going into the summer. Summer is the biggest time of the year when we use electricity because of air conditioning, and we're finally seeing electricity prices and household energy prices starting to turn the corner and tick downward after 2 years when they basically went up. So this is going to be a meaningful savings for people, and energy analysts I'm following seem to think that natural gas prices are going to go even lower. So that will be some nice relief for consumers later this year.
Yes, it will, Rick. Thank you. Appreciate it.
Bye.
Bye.
Well, U.S. Secretary of State Antony Blinken will visit China this week amid heightened tensions between the two countries. Blinken will fly out on Friday. It is his first visit to China since his cabinet appointment. He was supposed to make the trip in February, but that was postponed after a spy balloon linked to China was found in the U.S. The State Department says Blinken will meet with senior officials and, quote, discuss the importance of maintaining open lines of communication. Let's bring in Leland Miller, China Beige Book co-founder and CEO. Leland, it's been an interesting strategy coming out of the White House. On the one hand, talking about this visit as a potential thawing of relations, and yet what we have heard from Antony Blinken as well as National Security Advisor Jake Sullivan is really tougher rhetoric on China, at least around industrial policy.
Well, the hope is that there will be a nuanced China policy. So I think with the importance of what's happening right now with Blinken going over, perhaps followed by some other cabinet members later this year, is that the lines of communication have been broken down. And, that's not a big deal until it is. One of the pieces of leverage that the Chinese have used against the Americans, say, we're not going to answer your military hotline. We're not going to talk to you. It creates the possibility that you could have things blow out of control because there's not enough communication between the two. So just getting things back on track from a talking standpoint is not meaningless. And there's not a lot of hopes that anything's going to be accomplished anytime soon. But just getting people talking again is not nothing.
And so what do we expect from here? I mean, we've also had some movement on the part of the Biden administration in terms of regulation around U.S. companies doing business in China, but also Taiwanese companies that do business in China and the U.S. Do you expect, not necessarily as a result of this visit, but just in general, any kind of tweaks to that and how they inform the relationship?
No, we should expect very little to come out of this, both directly and indirectly. The reality is that, there isn't really an opportunity for a major thawing because there's not really that many areas of agreement between the two countries right now. They could stop the precipitous decline. They could open up the lines of communication. On the other hand, there's a lot being made in the headlines about how the Biden administration is full speed ahead on export controls and sanctions and other things. I think that's also being blown out of proportion. We've seen a lot less of that than what has been made out to be this unprecedented strike. So that's slow moving. It's slow moving. There is an effort to ring fence advanced technology from China, but it's incremental and it's slow, and it has not gotten buy-in from all the other allies that need to be bought into this yet. So you're moving in that direction, and things are going to be tense going forward. But also, I think that's being blown out of proportion a little bit too.
Yeah. So the first step here being get the lines of communications open again and up and running again. We did, the tensions that we've seen between the two countries have certainly made at least a lot of businesses a little nervous. Those that operate in China. We've talked about, sort of potentially foreign investment slowing down as well. News today, Bill Gates arriving in Beijing. His visit reportedly centered around global health. The tech giant will reportedly, or we should say Bill Gates will reportedly meet with President Xi at some point during the trip. We don't know exactly what the discussion will be, but I wonder what you're hearing from the business community right now, and to what extent a visit like this could maybe really reassure those who are a little concerned about what that business environment is going to look like for American businesses, multinationals in China moving forward.
Well, the business community has always played a role in trying to temper the hostilities between U.S. and China because they want to be in China and they want to be making money. But the role of the business community is much more limited now than it was in the past, simply because people have now elevated the relationship between many aspects of the relationship between the U.S. and China into the national security field and said, look, we don't care what businesses are saying. If there's a national security imperative here, that's what's more important. So, the days of you're not going to stop seeing Wall Street lobby itself quite crazy in order for better relations because they want to go in and make a buck in China. But the reality is that the days of the business community, the Wall Street community being able to dictate the tone or the pace or certainly the direction of the U.S.-China relationship, those are over. To the extent that you have some dialogue back and forth, sure, it's fine. But I think we should be very hesitant to make more of this than what it is.
Leland, let's sort of broaden the conversation here beyond just U.S.-China. You always got a good pulse on where the Chinese economy is. When you think about where things have been so far this year, yes, things have opened up at a much more rapid rate, and yet there seems to be concern about how quickly the growth is coming as a result of that. What's your sense as you look to the coming months, year end, about how quickly activity could pick up further?
Yeah, well, look, the major lesson should be that everything is relative. When the COVID zero Band-Aid was pulled back, at end of last year, there was this idea that the Chinese economy was going to magically reopen and great things were going to happen. Yes, it reopened, but one thing we kept pounding sand about is it's not going to reactivate anytime soon. December, January, February, probably into March, you're not going to see any type of strong activity for the simple reason that hundreds of millions of people are going to be sick with COVID, and it's going to take a while to break down the structures around the COVID zero administrative state. So, you had that earlier this year. The problem was that people came to this year really gung-ho about this ridiculous idea of a Chinese rally, stock market, economy, et cetera, early in the year. It was never going to happen the way it did in America because you don't have the same type of dynamics. You don't have a consumer culture. You don't have household stimulus out the wazoo the same way you have in the United States. So there was unrealistic expectations early in the year. Those were not met, but that's fine. Now we're getting to the point where it's the second quarter and it's go time for the recovery or not. So, looking April, May, now June, we have to be seeing much better data now, or they're going to be very, very tempted to come in with bigger stimulus. But I think the takeaway here is people got too negative too soon. We may see some disappointing Chinese recovery, but it's too soon to be making that determination quite yet.
All right, we'll have to check back in with you then, Leland. Thank you so much, Leland Miller of China Beige Book. Appreciate it.
Thank you.
Coming up, shares of Anheuser-Busch closing the day in the green, but concerns are brewing as sales continue to take hits. We'll have more on that when Yahoo Finance returns. Bud Light has been dealt a punch as it's been dethroned from the top spot in the U.S. beer market share in recent weeks. Here with more on the details, Yahoo Finance's Brooke DePalma. Brooke, so Bud Light how long has Bud Light been on top for?
It's been quite maybe even more than a decade, but now Modelo's actually taking the top spot here. They stole last month the top spot in the U.S. beer market. They hold about 8.4% of total retail sales in the U.S. beer market. Bud Light now dropping. They're holding about 7.3% of the total U.S. beer market. Coors Light coming in after that at 6.2%, and Miller Lite maintaining its share throughout the month of May of 5.3%. Now, this comes after more than 2 months of Bud Light's partnership with trans influencer Dylan Mulvaney for an Instagram post around March Madness. And following that, we saw a boycott from Kid Rock, which prompted a protest to boycott the brand from many U.S. consumers. After that, 2 Bud Light executives took a leave of absence. Then in early May, we heard from Anheuser-Busch CEO on an earnings call. Some think that he downplayed the situation, and that prompted some venues that support the LGBTQ plus community to reverse boycott the brand. But Bud Light trying to get a hold on the situation, change the narrative here. We know that they've invested significantly in marketing spend this summer. They aim to focus on sports, music, and connecting with consumers. And in addition to that, they also said that they would buy back expired brands, expired cases, that is, from distributors. But year to date, as you just saw, shares down of Anheuser-Busch 5.6%. So still trying to get a pulse on the situation.
Yeah, it's incredible to see how much legs this has had, right? I mean, it was just that one post, and we continue to see the fallout. How does Bud Light recover?
Yeah, I mean, that is the number one question here. And as Modelo takes the spot in the last month, it's important to note here that year to date, if you combine the total percent of market share that it's held since January, it does still remain on top. So Bud Light has 9% of market share from January until June 3rd. Modelo coming in after that, then Coors Light, then Miller Lite. But, you know, that 1% difference equates to about a $200 million sales advantage that Bud Light still has over Modelo. That's according to Bump Williams Consulting. And now when you look closer to what we're seeing in the latest sales week ending June 3rd, Modelo's still making more sales here compared to Bud Light. Compared to a year ago, Bud Light sales are down more than 24%. It's other brands like Budweiser also getting affected. You could see that here. And Coors Light and Modelo looking to, really take advantage of the situation. They're making more sales in the latest week. But also we're seeing, as you noted, more stories continue to unfold. Just earlier this week, we heard from country singer Garth Brooks, who has a new bar down in Nashville, and he actually plans to include Bud Light in his offerings. He wants to be inclusive of all brands. And so certainly lots more to unfold here, and we'll be keeping a close eye on it.
I was just looking, so Modelo is owned by Constellation
Brands, correct.
God, it's just, the whole thing is just...
Yeah, and shares of Constellation also benefiting from this. Year to date, they're up nearly 7%. And so investors looking to other beer brands during this time as well. And Bud Light, once again, losing shares. They're down about 5.6% year to date. And since this controversy began back in April, down 15%. So certainly feeling the pressure there on Wall Street as well.
Well, first they got boycotted by people who were upset about the ad campaign. But then, if you're LGBTQ, I mean, there are a few gay bars around, and gay people who drink, and trans people who drink.
Is an American top brand.
I mean, come on. It's just...
It points to the environment these companies have to operate.
Yeah, culture war is certainly taking a toll on many companies, not just food, not just beverage companies, but now it's expanding into retail. And so lots of fallout, all from back in April, and now Pride Month, certainly getting into more focus here.
Okay. Brooke, thank you very much. Appreciate it.
Well, the titan of real estate, Barbara Corcoran, joined our series, Real Estate, the New Reality, and spoke out on the lending environment for small businesses and the startups you often see on Shark Tank. Take a listen.
We're here with Barbara Corcoran, founder of the Corcoran Group, also a shark on Shark Tank, here in the kitchen. Barbara, thanks so much for having us in your home.
My pleasure.
So let's talk about the real estate reality right now. Lots of focus on commercial real estate. Elon Musk even weighed in recently saying that there is a looming crisis in commercial real estate. We might certainly see a meltdown. How dire is that situation?
I wouldn't call it dire, but it's in trouble. Of course, the Class A buildings have the biggest problems of all because all those tenants aren't using their spaces. When I go to Midtown Manhattan, I see maybe 50% of the space occupied, and in most major cities, it's 20%. You can't keep that up. You can't pay your banker. You can't pay off the loan if your tenants aren't occupying the spaces. So everyone who's saying there's not a problem there is not being truthful. We have problems looming.
Barbara, what's a ripple effect from that, just in terms of the impact on the economy and the impact really more broadly on commercial real estate?
Well, more broadly on commercial real estate, it should make people slow down to build commercial real estate, but those commitments have been out for like 3 years, so those buildings are going to happen. So far as other, probably the biggest problem with the commercial meltdown, to use your word, which I wouldn't call it that myself, is the banks. The banks aren't going to be paid. The banks we're speaking about are regional banks. They can't afford not to be paid. And so we're going to see some banking problems, more banking problems.
Let's talk about what's going on within housing right now when it comes to the residential side of things. Higher mortgage rates obviously has kept many buyers on the sideline. What do you make of the current environment right now?
Well, it's a choppy environment and a nervous one, and it shouldn't be. I think people are coming to the wrong conclusions on buying a home right now. I think it's the absolute best time to buy a home for a couple of reasons. One, interest rates will come down again, and if you buy it now, you can refinance. And also, if you wait until interest rates come down, even by 1.5 points, I think all hell is going to break loose. Everybody will come charging the market, and you'll be paying another 10% for the house. So there's nothing in my logic that says it makes sense to wait. You ought to jump in now and get the house while you can when there's less competition, and it's still very competitive.
What does the timeline look like on that, just in terms of rates dropping and the housing prices potentially jumping 10%?
Well, the minute rates come down, who knows what's going to happen? We've had 11 increases in a row, and people are anticipating the rates will be kept steady or possibly come down. But the minute it comes down substantially, like north of 1 point, everybody's going to charge the market. That's the timetable on the whole thing.
When it comes to those first-time home buyers, many of them have been on the sidelines because they simply cannot afford houses right now. When it comes to home affordability, do you see any improvement along those lines, or what's that going to take in order to see improvement with that situation?
Well, what dictates first-time home buyers, which is the inception of any market cycle, is really jobs. And there's been tremendous job growth. There's been very little unemployment. I think there was a survey I was reading last week where they said the typical home buyer is spending another 15% of their income on housing right now to keep up with it. No, I think we have a lot of growth. I think it's very hard to get into the market for the first time, and 2/3 out of all the purchases are all cash. You know that. So it's the rich people are buying now, but I think when interest rates come down again, the middle class people who want to get their first house will jump into the market with fervor.
What are the most attractive markets right now? If you had to name a top 3 place to buy, what would those locations be?
As a house?
As a house, yes.
Well, I would have to say Manhattan first.
But you got it.
But the Manhattan market has just ticked up, but most people don't believe that's the best place to buy. I think Pittsburgh is a phenomenal market to be buying in. Prices are up about 20% a year. The youth is coming in there, the most educated population. People are real estate friendly. There's new development. You could pretty much live very well in Pittsburgh today, which you can in New York if you're a middle-priced worker.
How do you see, with more and more people working from home, that has certainly had a massive impact on real estate where people are buying. We've seen popularity in the South and the Sun Belt region. How much of that has to do with the remote work, and what do you make of that trend as a business leader, as an investor?
That's not going to go away. I mean, the young people will not come to work full-time unless you want to settle for less good young people. If I want to hire for a new position, the first priority is, can I work from home? And we have a hybrid model. Sure, you work from home as long as you get it done. Any employer who doesn't have that attitude toward young workers isn't going to get premium workers. It's just the way it is. So that's not going away.
Let's talk about renovations. We know so many people were renovating their home during the pandemic. If they weren't out there looking to relocate, is now still a good time to make that home renovation
Yeah,
decision?
because prices are coming down. Lumber has come down. You could get the supplies you need. There was a period where you couldn't even renovate, no matter how much money you had, because you couldn't get the supplies. That has totally changed. The problem is finding a contractor. Contractors are busier than anyone else on earth. So if you find a contractor who would take your job, you're in luck.
And if you're making that home renovation, what's your top tip? What should people be considering when they are making that decision?
Make sure you have the curb appeal you want. And the curb appeal today happens online. So when you have that first beauty shot of the house, it's got to be in the best season, the best look. Even if you paint it in, you paint in the bushes, whatever you have to do, make sure it looks like somebody wants to come and get another peek. And once you get into the house, the two best improvements are improve on the size of your living room rug, because people will judge the size of your living room based on the rug. And the second thing is make sure you buy a new refrigerator. They will not open the stove. They will not really open your cabinets, but they always open the refrigerator.
So buy a new refrigerator.
Yeah, of course. It's worth spending a lot of money on.
We're sitting right here in New York City, an area that has a massive amount of empty buildings, office spaces that simply are not being used. What's going to happen to that?
Well, the Class B buildings have smaller office plates and they have more window space. So they can be converted to co-ops. Nobody's done them yet, but I can't imagine that not going to happen. The cities don't stand in the way of that. They want to see the redevelopment. But the Class A buildings of 25 years ago on Park and Fifth Avenue, the best buildings in town, they have a problem. They really have a problem because they can't convert to any kind of a loft space because they're huge plates. They don't have the window space. You have to have windows to convert to residential. I don't know what's going to happen with them. Your guess is as good as mine.
But what's the best way to play the commercial real estate market right now? I think a lot of investors are at home asking maybe now's the time to get in. Where are the best opportunities given the outperformance of some of the asset classes within commercial real estate? What do you think?
Well, you know, commercial isn't just office space, which everyone thinks of it as. I think the industrial sector is booming right now, and you can't get in cheap, but you can make a lot of money. Retail space, you get in cheap and you can make a lot of money, and multifamily housing is doing so well. So I would say those three areas versus the office market is the right place to buy right now.
When it comes to retail real estate, I think that has a lot of people scratching their heads just in terms of the fact that so many people during the pandemic were spending online, weren't going to stores, but shopping centers, office space, have really been able to attract those consumers back. What do you think the trick is?
The trick is that people like to touch and feel and smell what they're buying. People want to get out and see what they can buy with their hands. It doesn't mean that it diminishes the ability to order online, but the retail sector has come back at a lower price, but it's come back definitely because people want to shop.
Our thanks to Barbara Corcoran there, speaking to our very own Shauna Smith. Well, coming up, it is closing time here on Yahoo Finance. We're going to get you caught up with the top stories of the day. Stick around.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Now it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The Fed officially pressing pause. The central bank holding rates steady after 15 months of interest rate hikes, but leaving the possibility of more tightening this year on the table. Stocks initially sold off on the news, but as Fed Chair Jay Powell held his news conference, markets climbed from their lows. Powell reiterating that the Fed will be data dependent, and he said July's meeting is live.
One of the top trending tickers today, United Health. The stock sliding after the company said costs were rising amid more surgeries. Previously, insurers had benefited from people delaying non-urgent surgeries because of COVID. The company losing more than $40 billion in market cap or market value as a result of today's decline. But the warning from United was good news for medical device makers. Those stocks got a big bounce today.
And oil giant Shell raising its dividend and share buybacks. The company also saying it's going to grow its gas and LNG business at its investor conference today. And it's also going to maintain its oil output. Shell's CEO trying to increase investor confidence by focusing on financial performance.
And that does it for us here on Yahoo Finance Live today. Be sure to come back here tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.